So, welcome back to the Compassionate Capitalist Show. And today we are going to be talking about something that is very near and dear to my heart on a couple of different levels. So let me set the stage here because I have a very special guest that has some really wonderful insights into two things that are great for me, for what I try to do with the compassionate capitalist concept of compassionate capitalism. So first off, the organization that my guest Harjit Singh is with is KiwiTech, and I first became aware of KiwiTech in about 2017, and then in 2018 I started attending their angel investor um, their pitch displays. It's like a I didn't really know exactly what to call them, and we'll get the right name here in just a second. But where I would go to these events and these really wonderful companies that software, mostly software companies, I guess all had some form of a software that KiwiTech was specifically helping them bring their solution, their idea, their vision to market, and then was turning around and helping them raise the capital as well. And it was, to me, a really perfect example of compassionate capitalism. And particularly when I heard the story, which I'm not going to steal the story because I want Harjeet to share that. And then when I first met Harjeet, because he came to me to be a guest on one of the Kiwi Techs, because now they do in the virtual world, they do these podcasts, or not podcasts, they do these webinars where they have panels and people talking about their expertise in angel investing and investing in women-owned businesses and entrepreneurs and family offices and all kinds of topics. And I was on talking about my podcast and angel investors and the benefit it is to angel investors. And we got to just talking, and we had a couple of conversations. And I said, would you be on my show to talk about your vision and your passion for crowdfunding? And so that's the other piece of this, because for you that have listened over different times, you know that I really do believe that the Jobs Act in the United States, equity crowdfunding had been available in different stages in other places, but when it finally started to happen as a response to the economic crisis of 2010, so it was really like 2012, they started rolling it out and didn't really get going with all of the aspects and Reg CF until about 2017, and then it was only $1 million. And just for those that aren't familiar, so within equity crowdfunding, we have intrastate, which is in a state, a company in a state to investors in the state. We have Reg D 506C, which is a national program, but only for accredited investors. And then you have Reg A Plus, which is a national program, large amounts of money. It's for companies that are more mature and have potential, because it's kind of like a backdoor into going public. And then, and it's accredited and unaccredited can participate. And then you have Reg CF, Reg crowdfunding, which started out really as a response to reward-based crowdfunding. And it was very intended for smaller concept kind of companies, and they maxed out at $1 million on a national basis, and then it went to $5 million, but it's accredited and unaccredited. And so three of those have the ability for the everyday people that have discretionary income to participate in one of the greatest ways to create wealth, which is to have a successful entrepreneur. And you get to share in that success when you invest in that crowdfunding. So we're going to unpack all of that and the great, big, bright future of what KiwiTech has to be able to really pull that whole ecosystem together. And it's really very exciting. But so first, let me give you some more intro info. So you, not just my words, let's just talk about what it's all about here, right? So KiwiTech has a portfolio of over 300 tech startups across the US. That's a big number, folks. And they have a goal to have 1,000 portfolio firms in the next 5 years. As a technology services company, KiwiTech helps entrepreneurs build their dream tech startups. Okay. I didn't want him to have to be an infomercial, so I had to do the infomercial on that. And Harjit Singh, in particular, has 10 years of investment banking, private equity, venture capital, and trade finance experience. Harjit is a strategic advisor to Tiger Bridge, which is assisting with building the firm's presence in the India market. He is also a co founder of Scourge Capital Partners. How do you say that?
Surge Capital Partners.
Surge,
Surge Capital Partners.
But it has an X on the front, so that was my challenge there. LLC, he is a managing director responsible for the company's business in North America and Asia, with a particular focus on cross-border Indian opportunities. And specific to our conversation today, Harjit manages corporate strategy for KiwiTech, and his responsibility is to raise capital as well as look for strategic acquisitions for KiwiTech. And it's just really exciting, all the things that he's putting into place and the roadmap that he is building. So officially, welcome to the show, Harjit.
Thank you, Karen. Thank you for a great show, and it was a pleasure having you at our KiwiTech panel. Just wanted to correct, KiwiTech is the largest tech for equity platform on the planet. You think about Y Combinator, you think about 500 startups, a lot of other accelerators, which are basically investment-based platforms where they physically put in capital in your company, and then they provide mentorship and bring other investors to your platform. KiwiTech is a little different. We do not invest physical capital in any company. What we do is, you probably understand this, Karen, like one of the biggest challenges in the startup ecosystem is building a product.
Right.
Product market fit, right? And one of the most expensive tools when you're building a company is development. So a lot of these non-techies who are founders, and we have seen so many successful of them, when they try to build a company, they're looking for a co-founder. Usually they wind up giving over 30, 40, 50% of the company, saying, hey, you bring the tech, I bring a finance background or a strategy background, I know how this product sells, or what have you. Sometimes it's less than this, then you're paying a hefty salary to your co-founder or your senior developers in the team or your CTO. So KiwiTech solves this, right? So if you were looking, let's say, about a $500,000 worth of development, we'll physically at a $5 million, just giving you an example, at a $5 million valuation, we'll take $250,000 of equity in your company. And then the remaining $250,000, as we are providing these services to you, we'll take this cash as we are delivering these services on a monthly basis.
Yeah.
So we have 500 people in our tech team in New Delhi. We're a US company. So just think of what Accenture is for enterprise, KiwiTech is for startups. So we, on top of that, think from a C-suite point of view. Under CTO, we do technology development. Under CFO, we do bookkeeping and controller services. And now we are growing into a couple of other business opportunities. Like I told you, crowdfunding is I used to run a broker dealer on Wall Street in my previous life. And crowdfunding is market. We look for looking at an active acquisition of in that marketplace. On top of that, we're looking for a digital marketing agency. So it's probably one of the best ecosystem, other than in the next, it started in 2013. In 2021, everything is coming together with a 400, just to want to correct you, we have 400 plus portfolio companies right now.
Wow.
Yes.
Well, so, I mean, that's the thing. And that's why I felt when I first met KiwiTech, and I forget exactly, one of the founders had invited me to the meeting here in Atlanta, and I got to understand that, and that's why I call him like truly an example of compassionate capitalism, because they had phenomenal success in the IT space of developing applications for corporate companies and doing this. And then it was like, they said, we could continue on and we could get richer doing this and just selling our expertise and doing this. But what could we do to amplify, bring an innovation to the market if we partnered up with startups that had really, really clever and creative ideas to solve a problem in the marketplace? And sometimes it's not just startups. I've been in things where it's been a company that has been around. They've got a couple million in revenue, but then they decide that KiwiTech is going to be their partner because they're developing an app that is takes their business from this point to this point, if they, integrated this app for their consumers or expanded into this whole other marketplace, or they saw an inefficiency in their industry and they needed to create a software solution. And I've talked to these entrepreneurs and I'm like, well, why did you pick KiwiTech? Why did you pick KiwiTech? And it all comes back to feeling that there was a shared risk in this, a shared gain in this, and a true commitment to the company's success. And in fact, I had a client that I was working with, I'm a shareholder in, that I was like, you're not ready for KiwiTech. I thought that they would be who we would bring in once we kind of got to the next level of app with them. And he found KiwiTech on his own. And I was like, all right, whatever KiwiTech, if KiwiTech gives you that rubber stamp of approval to take on this first phase of this, then we'll roll. And we have, and they've been helping to get him ready to go to market. We've had some stops and starts with that. And then I have another company that I'm invested in. They found KiwiTech and they called me and said, hey, I think I saw you on something with KiwiTech. What do you think of them? And he's going through the approval process. You guys have amped up so the fact that you have 400 companies, because I know from his perspective, it's a rigorous approval process to get through that approval. He was participated in watching the webinar that I was on, to get a better understanding. And I said, absolutely, if they approve you, because he has really struggled to find the right development team to get his solution to market. And I think that KiwiTech is that group. So, there's the mutual love thing on that. So
But I wanted to add one more thing here. See, a lot of these technology or founders, what they have code in Malaysia, Philippines, India, Eastern Europe. KiwiTech is one place where you have that code under one place, right? Secondly, once you come into the KiwiTech ecosystem, then what happens? We did over 100 events last year, right? So we had 43 demo days. So at each of these demo days, 5 to 6 companies pitch. You have anywhere from 30 to 50 to 100 investors who are attending these demo days. You get access to investors and professionals and people who are actually working in the field who can advise you on what you should build. Hey, maybe you want to build a UI, UX experience the tool a little differently. This is what exists in the market. So it eliminates a lot of duplicate. There might be a business model that might be different. You might want to build a B2B model, but there might be something that exists. You might be wind up building, when you partner with us, a B2C model, right? So that's the whole thing, right? In order for you, when you're building a company as a founder, you're so driven and think that this exists. But when you come to KiwiTech and you start attending all of these events, it's like, you're getting education, you're getting a mentorship, and you're getting access to other resources that you might not have as a founder.
Yeah, absolutely. Absolutely. And I think their model has even expanded so much under COVID, right? Because it was, the old model of, and it'd be interesting to see what happens come 2022, because 2021 sort of, who knows, right? But 2022, will they go back to the in-person piece, because there's a benefit of being able to follow up with the investors that are in the room. And I can tell you this, particularly when I've been to events of theirs in Boston and New York, the people in the room were real investors. They fill the room with real investors. But on these events, because they'll have panels of VCs and family offices, the expansion of their ecosystem has really amplified in 2020. And doing these events, it seems like they've really escalated the content or the volume of events, because you don't have to have that physical issue of scheduling somebody to fly in or drive in or that kind of stuff, pay for, do the lunch, the logistics of that. This is just getting to business with the companies in a certain industry or a certain sector, the investors that are in that sector, and then all the other people that participate and watch. And so I just think they've got a very efficient model, and I really am a big fan. So, so let's talk about this idea, what you're bringing to the table for them in the preparation of a company. So a company, it's not just about the tech, it's how do you deliver, how do you do market discovery, how do you then communicate what your market, your product or your solution is doing for the marketplace. That kind of comes into the digital marketing side of the things that you're looking at. And then how do you raise money, not just from the narrow gauntlet of an angel group, which is a core component of it, but some industries fit really well with crowdfunding. And crowdfunding, there's a debate going on right now, particularly as they expand this out. Does it make investors, the traditional angel model, obsolete? Does it coexist with it? Does it, how does it fit in all your different levels? I, for one, believe that it coexists and reduces the risk if you can effectively do a crowdfunding campaign in one of the four categories that I talked about, and even the fifth, which is reward based. It's not equity, but if you can effectively integrate a strategy to crowdfund along with traditional capital that might come from friends and family, traditional angel investor groups or networks, and VCs, you have a really winning combination that gets innovation to market and does what compassionate capitalism is all about: innovation to market, creating jobs and creating wealth for all those involved. So that's my platform. Please, Harjit, share your perception on why you thought it was so critical to bring that element to the ecosystem of KiwiTech, and then we'll roll into really some of the stuff that we were talking about earlier about crowdfunding.
So as we are looking into it, Karen, and you see this, a lot of things that are in the news, like people are not investing into women as much. People are not investing into, minority entrepreneurs or colored entrepreneurs, right? So there are a lot of challenges, but when you have a great product in the marketplace, right, it's easier to raise money where people are using your end clients, right? Depending on where you want to be and what you're building. KiwiTech has a fascinating platform of getting startup companies, helping build their tech. If you talk about job creation in generally, where does it happen? Do you think Bank of America, Amazons of the world, or JP Morgan can hire? Startup companies hire more people. If you empower small and medium enterprises, just look from an economic, benefit, right? The amount of jobs that the startup companies create in the startup ecosystem, I don't think you can compare this into a larger landscape, right? If you empower those companies.
Right.
Two, we have 400 companies, but once they come in, they usually have an angel investors. They already have investors on board. Not everybody is going to raise money through a venture capital model. And not every company is investable because they're looking for a hockey stick growth, right? Mm-hmm. They're looking for some kind of attraction. If you look at a company seed funds, they won't even talk to you if you're not doing $1 million or $2 million in revenue. Then a Series A would not even talk to you if you don't do $3 to $5 million in revenue. Let's be honest, in private equity model and what have you, right? So that is traditional capitalism. But sometimes a company has angel investors just to build that product. KiwiTech companies like KiwiTech or others, they'll help them build the technology, or some founders will have their own tech teams. But now they have a product, or they have a tech, or they have a technology that they can sell, but they want to raise money, but they're not doing that type of revenue, but they have a fascinating idea. They have a fascinating invention. So like you said, crowdfunding, even if you look at how many companies successfully raised $1 million. On the other hand, look, I'm sorry for going on the different routes. We don't have, think about number of companies publicly traded in 2000 versus today. Right?
Yeah,
so it's a really double-edged sword. You have more investors from a private equity point, from angel investors, from VCs, others. So you have to create more opportunity for companies to go public. So even NASDAQ and New York Stock Exchange, they see this, and major markets around the world see this problem. And the biggest problem is US is behind like 10 years in this game compared to the global market, right? In 2019, the global crowdfunding was roughly, I believe, 18 or 19 billion dollars, and a few billion dollars more in 2020. US, the United States of America, the biggest capital wealth creation society on planet Earth, we did only $500 million, right? So
Yeah.
look at us. So I think what this does, crowdfunding enables these type of companies who have great ideas. They can't raise money traditionally, but they have great products, is to raise money on a crowdfunding marketplace. Look at what happened to AgFunder, Republic, Startup Engines. These are success stories. Look how many companies are on those platforms. These are just to name a few. There's many of them. And there's an interesting platform by Maxim Group, which is a mid-sized boutique investment banking platform. It's called M West, right? And I
Oh,
was talking to
sure.
them about interest, right? They have created a nice platform. So KiwiTech has 400 different companies, and we think a lot of our companies, if they don't go the traditional angel venture capital round, we do, out of 400 plus companies, we do have like close to 30 to 40 great companies, but we also have companies which have great products, which I think they can succeed. Crowdfunding becomes a great way. Another double-edged sword is, Karen, as a society, as a race, there's a lot of prejudice, discrimination, even on how much money you make. That allows you, if you're not an accredited investor, you don't make $250,000 for the past 2 years, and you're not going to make that next year, you can't invest into a lot of these opportunities.
Right.
And if you're a couple, it's about $300,000. So why is the society limiting these? It's like we are, putting so many regulations, weight on regulations, is to keep these people down who might have decent education, who said, okay, we can't invest, $1 million or $10 million, but hey, we can invest $500 into a company, right? When we can invest $20 into a product. Think about a lot of these companies that raise, shaving blade type of company, that company that is selling blades for $1. Others, even if you're making a product like this, it's a great product. It's an AirPods, but Apple is not the only company to make it. There are a lot of other great technologies out there, right? So you're empowering these companies to raise money for people. Not everybody could spend $200, but if there's a product for $39 out there, right? There's a product for $19 out there, but that company is trying to get off on the ground, and they have a lot of clients. Let's say a company that is selling, for lack of better words, they have like a Bluetooth device. It is AirPods. They're better than Apple, and they have almost 700, 800 customers, right? And they love the product. For them, they said, okay, we want to raise $500,000. They send out an email out to all of their clients saying, hey, or customers, hey, we are raising money. Since you gave us a great feedback or you bought this product, tell us what you think. Would you like to invest, let's say, $500 into us?
Yeah.
Look, investing $50,000 or $500,000 or $5 million is a lot of money. But now you're talking directly to your end user.
Yeah.
So you're taking out all these brokers out of the middle. You're saying with this $500,000, or let's say you're raising $500,000, you're talking directly to your clients to invest into a product that they really like, right? And obviously, I think people who buy AirPods, there is going to be an income gap, but versus people who buy a product of $20 or $30 who really love your product. Yeah. We can take this conversation various ways, but I think crowdfunding going from $1 million now to $5 million, these companies, you're like semi-public, then go through a Reg A market, right? Then being listing on NASDAQ or New York Stock Exchange, depending. So this is going to empower and create millionaires. And I think the financial literacy, which lacks in this country. We don't get financial education till we're in Dame College when we take Economics 101, or we take, depending on finance and investment, depending on which university you go. These are the discussions people not used to having at home in high school, right? I am surprised that, this is picking up. My niece, who's a junior in high school, we talk about finances all the time. And she told me, look, these programs are getting implemented. So this all comes from education perspective, then to making an investment. Even she said, okay, I got a $100 gift card. Uncle, I really like this company. I am somebody like who's used to giving gifting, like stocks to my nieces and nephews and my kids. So that becomes a great tool to empower the society. Look, forget about you. I'm not going to buy you an AirPod, but look at this device. You like this company? What do you like? Do you want to buy shares in this company through a crowdfunding marketplace? So you're creating a great society or a community. in this place. But in crowdfunding, I'm very, very excited. KiwiTech is very, very excited because we have the ecosystem, and we're putting together great partnerships across across industries. We are in every single industry except biotech, because I don't know what we could do from a software side in that industry, but we're in every single industry, and we're here to empower entrepreneurs across the globe. Crowdfunding by 2025, I hope, and I'm looking at a lot of projections, but in the US, I think we'll be close to a $5 billion market, which is, look at, we're at half a billion. If we can grow 10 times in the next 4 to 5 years, that's a pretty exciting time. It's
Yeah.
going to become an
Yeah.
industry on its own. And most investment banking firms will serve other than public startup engine and ag funder and we funder. There's so many of them that are there. I think they will definitely raise the profile of these companies.
Yeah. Well, and just I should probably a caveat on this is that two things. First, absolutely, customers have always been the best source of way to grow your business with revenue. But now, because of these different ways to crowdfund, you can reach out to them. And I have that conversation with entrepreneurs all the time. Is you reaching out to them to let them become shareholders in your company, but you must have the legal documents and the structure to be able to do that. You can't just take money from people based off of an email. That will come back and bite you in the you know what, because you have to have it is a regulated industry. There are rules and regulations on how you solicit and general solicit, and you need to be structured for that to be able to do that properly. Otherwise, you'll get in trouble. Just like, used to be the way was just who you knew. And angel investors would give you an entree into who you knew. You had to have a private placement memoranda unless the angel group gave you a term sheet. Though you don't use those really within the crowdfunding model, but you still have to have a structure to be able to do that. You still have to have an offering document. You still have to be able to receive the capital. In some cases, like on the 506C, you have to be able to have an escrow agent to take the money and transfer that. In the Reg A Plus, you just have to have a transfer agent, just like a public company does, to take your money and then report back to investors. So there are some rules. So make sure you get the proper advice on that. And then on the investor side of that, don't plan on just doing one. This is one of the whole reason why I wrote the book. I had dusted off my ebook that I had done to build my angel group. But for those that are watching, I'm pointing to my book, Inside Secrets to Angel Investing. To those that are listening, Inside Secrets to Angel Investing. I believed at the time that the Jobs Act came out in the US, that the greatest barrier to entrepreneurship and innovation getting to the market was how hard it was to raise capital, and that you had to be in a town that had an active angel group and liked your industry and whatever, check all the different boxes. And this whole idea that Hajit has brought up is the idea of the bias that some investors have, and the majority of angel investors at that time and still today were white male. And so if they had a bias on the color of your skin or your sex, then they would, or how you dressed, then it might inform their decision. Okay. And so that has, it's the statistics and the data has shown that when it comes to crowdfunding, women and people of color are much more successful in raising capital in a crowdfunding model than they are in the traditional model. And so, and part of that is they get the opportunity to tell their story. But I had this huge thing that crowdfunding would get a bad, because investing in entrepreneurs is already something that has a filter on it, that it's too risky or it's too this or that. It's too, all these kind of things. And I believe it's not any more risky than real estate or the traditional stock market if you approach it the right way. But I was concerned that a lot of people would invest on a video. They wouldn't do this. They were unsophisticated. They just would be emotional. They'd invest one or two times. And you have to have the same discipline. And although I don't do a lot on crowdfunding in the book, it's really about overall investing and figuring out how much you can invest and what industries to invest and the tools to do that. you still need to go through the same process. You still need to figure out your budget. You still need to make a commitment to invest X amount of dollars a year or a quarter over a period of time to get a diverse portfolio of companies. And you still need to do some due diligence and research it on this. If you decide you love the idea of using the iPod thing, you really do think they need to come out with a new type of headset, stuff like that. Well, chances are on all the different crowdfunding platforms, there might be a half a dozen ones that could compete against the earbuds. So go figure out which ones are the best ones, and then you put your money in that. So once you find a product that you want to find a solution for a problem that you're experiencing, or something you learn about in an industry or something like that, go ahead and look and see who all is doing that in the crowdfunding, and then decide, is my minimum investment or 200 or my maximum 1,000, and I can put 1,000 in a quarter. Then do your research and take it on as a hobby that has significant financial benefits, and get started. And one of the things, I'll say this before we move on, one of the things that made me aware of that, two things happened when I was WeWork had hired me to come and do a workshop, and I was doing comparison of angel investing to ICOs or digital coins, Bitcoin kind of stuff, and real estate and stock market for wealth creation. And in my audience, I was really surprised. There were millennials. They were making under $200,000 a year, and they came to learn how to invest in crowdfunding companies. That was why they were there. So there's a whole generation of potential sophisticated investors that grew up in reward-based crowdfunding. They bought these fidget widgets when they were just a reward base before they ever did equity crowd. Millions of dollars went
Yes.
into fidget widgets before they ever got their first equity funding from a venture capital kind of a thing, right? And so they understood the power of crowdfunding to bring products to market, and they wanted a piece of that action. And then Jason Kokonis, who is well known because of his podcasts and TechCrunch and all this stuff, and he wrote a book that came out the same time I called The Wings of an Angel. The same time my book came out. They're sold together on Amazon a lot. He was interviewing the founder of Seed Invest, which is one of the early companies to come into the marketplace, and I think the founder is Indian descent. And he was interviewing him, and he said that he's also really part of his famous is that he was an early investor in Uber. He saw the vision of Uber early on. But he said if he started his first company when he was like 22, and he said, if I could do over knowing what I know now in my older, smarter self, I would go back to when I was 22, and I would say, go get a corporate gig. Don't start. I wouldn't have started my first company and struggled with all that stuff. I would have got a corporate gig paying me lots of money with benefits. And instead of investing in the 401k, I would have invested $500 a month into a crowdfunding company. So at the end of 5 years, when I would normally have been vested and been able to receive all of the benefits of the matching money on investing in the company's 401k, I would have invested in 60 companies, about $30,000 over that period of time. And if you just do the normal math of what all the angel investors and VCs say, that what happens in 10 companies, yes, some of them would have failed. But out of that, I would have had 5 companies that would have hit it out of the park and made me about $300,000 out of my $30,000 or more in that period of time, which is a lot more than I would have invested in my 401k, or the value of my 401k for a $30,000 investment. I might have 40,000 or 50,000, not 300,000. I was like, oh my God, that is so right. That's why this is the great economic democratization of the capital markets, because all of the everyday Tom, Dick, and Harrys and Janes have the ability to make wealth on entrepreneurs the same way that most wealthy people have done it for generations and for decades, since the 1920s when they started, 1933 when angel investing was kind of first invented. So that was a mouthful, but I got my
So
passion out there. And talk about what you have seen, because you're like, just give us an example of what you see in the change that is happening in India as a result of entrepreneurism, access to capital through this, financial literacy, and then we'll apply it to what you see going on as you travel around and be and are involved in KiwiTech's great model to bring all of this opportunity of crowdfunding to the 400 companies they have in their portfolio.
So so great information, Karen. First of all, your book is great. I think anybody who's looking to invest into early stage companies or looking to invest in general, don't just throw your mind because your friend is thinking about this. You have to read content. You have to read, why are you investing? Why are you investing into a company? Why do you want, what is the end goal? Is it to become a billionaire? Is it to become a multimillionaire? Where do you want to? Is it to create passive income? What is the goal of investing? And I couldn't agree. The founder of Seed Invest is Ryan Felt and James Han, who's an Asian American. So coming from there, I couldn't have agreed with them more. So if you look at KiwiTech, why do people see? We have raised about $30 million up to date, right? Even during the pandemic, people invested in KiwiTech. Why? Because we give them access to these companies. We give them access. Some of them invest in us, then they want to invest into those opportunities which are on portfolio because they see us. We had 6 exits so far, right? And we have companies which are tracking. When we started working with them at $8.5 million valuation, now they're on their way to over $250 million valuation, right? And some were low, some are high, but that's the power of an ecosystem. When you create, what exactly do you want to create is our founders, Rakesh, Neil, and Nita, who were son of an immigrant who came to America in 1949. Rakesh is the only one who ever held a corporate job in Oracle. His 2 siblings, they actually worked for KiwiTech, and the 4th co-founder, Gurvinder, they built a BPO content company in their previous life. Then they see, okay, we want to invest in startups. So coming back to your example, they looked at many options. They're like, okay, if we just invest, we are part of the problem. We want to create an ecosystem so we can empower people to invest into an ecosystem. That is the history of KiwiTech. The founders have a great exit in their previous company. So that was the formation of KiwiTech. What you just said is to empower other people to, hey, don't just invest in one company. If you 1, 2, 3, 4, 5 might fail, but if you invest in 10 great companies, maybe and align yourself with other angel investor, other like-minded people, industry specific, if you're into health tech, fintech, or cryptocurrency, what have you. But then you drive your thought is exactly where do you want to invest in. That's how you create wealth. You have to allow yourself to be part of that innovation where a lot of like-minded and not so like-minded people are there or talking about disruptive ideas.
Right.
And that's how cryptocurrency was born. That's how I'm sure the founders saw a lot of naysayers, even KiwiTech. And I am just, I joined the company a couple of years ago, and this is probably the most exciting time in KiwiTech's history as we are growing. But if you want to invest, I like your advice. Look at companies like Seed Invest, look at Republic, WeFunder, look at those companies with great products. Why are people buying? If you are buying something, look at who's making that product. Where is it coming from? Why are you using that platform? That's how that's how you should invest, right? Rather than you're telling your friend who your buddy invested into some company, okay, I'm going to throw a few $1,000 or 15, 20, 25, $50,000, and you don't know anything about that business line, right?
Right.
To invest into and looking into deep why people are buying that product. But great hidden secrets in Karen's book, Inside Secrets. I encourage you to buy it. And this is, I read a lot of content. I'm on the board of TIE New York. TIE is one of the largest ecosystem of investing into startups. It started in 1990. They have over 3,000 angel investors on its platform. In New York, we started with few investments from 2015, 16. We just invested close to $300,000 into one of the startups, and we're going to continue to do this over a period of time. But I like your advice, Karen, on how to invest into startups. Why should you invest, and the idea of wealth creation overall.
Yeah. Well, and then one of the things I always say is, I think the new midlife crisis isn't to go out and buy that fancy red sports car. It is to leave a good job that you're bored with and go start a company because you think it's going to be more exciting to start a company. Well, yes, it will be exciting to start a company, but it's a whole lot harder than you think it is based on your cushy exec job. And so what you have to do is, I believe that a better thing to do is to say, take that instead of, and it's a whole other conversation about that. But unless you have a really, really, really breakthrough thing, or you just, like to work more hours for less money for a while until get there, take your extra capital, figure out how to carve it out, and go get your passion from the passion of the company, the compassion, and become a capitalist by investing in those companies. The other definition of compassionate capitalism. So, one of the things I want your perspective, Harjit, on, because you come from an investment banking, a Wall Street banker, and there has always been sort of this I don't want to really, I don't know the exact term, but there's a hierarchy of perception that investor bankers and Wall Street is where all the money's at. They even a lot of times don't, it's like a hierarchy. VCs think angel investors are lesser than the VCs. Angel investors thinks friends and family, and Wall Street thinks we're all the cat's meow, right? So going from that, and I mentioned at the very beginning, at the top of the podcast, this resistance that a lot of traditional angels have against companies that might bring in a block of crowdfunding. And that's one thing, when you raise money under Reg CF and this stuff, usually it's done in a block. So they have one voting power. It's not a lot of individual people that have invested 500. It comes in as a block, just like an angel group might come in as a block. Um, Talk about what you see within from your Wall Street background, and is there a changing tide of how the perception of the value of crowdfunding, and the company that might come in through the back door of coming in through a Reg A plus versus a traditional going public model that is, very complicated, the whole value proposition is much different. It's talk a little bit from your perspective on what you see happening in the marketplace, and the shifts in attitudes and
So,
actual access.
but you see a lot of the business model, even in Wall Street, is changing, right? I'm sorry about the noise. I'm in India, so cars are passing by. I'm sitting close to the door.
You're okay.
But in terms of where we are, so you see Wall Street business model, they have to shift, right? The margins on typical trading in bonds and equities have shrunk tremendously. Second, on the investment banking side of business, the fees on M&A versus companies going public. How many companies you saw last year and up until date direct listing, right? Because they don't want to pay the middleman. They don't want to pay Wall Street firms all of this capital. Crowdfunding allows them to do this, right? From a due diligence perspective, after Reg A raising $75 million, this company is going to probably raise $250 million, depending on how this company, then they're going to raise $1 billion and more, right? So this will allow more companies to list. One of the topics that we started out in the beginning is look at number of companies listed on an exchange in 99, 2000 versus today. So I think from the securities industry, this is the way for more companies to get listed, create more options, right? The bigger companies are getting bigger and bigger, and I think this will allow more companies to get funded as well. So crowdfunding, putting on my Wall Street hat, is actually good for investment banking, is good for Wall Street, because there's more companies looking to raise capital. And I think great companies who are able to survive the Reg A plus and beyond will be able to raise a lot more money and become successful companies.
Yeah.
I hope that answers your question. I think this is definitely a win-win situation for Wall Street.
Yeah. Well, and I also think one of the things that you have a challenge with when it comes to some of the companies that are unicorns, everybody talks about unicorns, right? Well, the reality is that unicorns usually become unicorns because of so much money that's been put into them, not necessarily because of the revenue that they're generating And it's just there's been a lot of valuation increase, so they're valued at $1 billion, but they're not doing $1 billion in revenue. They're not, they're far away from doing that. One of the Snapchat is probably one of the classic, like, what up with that? You know what I mean? They didn't even know what their revenue model was when they had $1 billion valuation and they went public, right? And so the investors that jump onto it after the fact, they struggle because the market was the value was overinflated and immediately took a nosedive. And so, that happens a lot with those kind of companies, where when a company gets there, and that's when companies get there, they get angel investing, and then VCs come in, and then bigger VCs, and they're growing in this tech model, trying to get to that hockey stick of revenue and potential. And then, the push to exit, and that's, drives them to go public. So they're the people that made money on it were those investors that drove that valuation, and then they get to exit out at that higher. I bought it at 25 cents and it goes public at $25, and look at my big return on investment. Well, the difference, I think, when it comes to crowdfunding should be much more what an investment banker, because they've had to earn their stripes, so to speak, because the only way you are able to raise crowdfunding money is that you make a lot of people aware of your company, so that they want to buy your product, and at the same time you're attracting investors into your company. So you have this growth, this natural growth of earned revenue, because you have a superior product, you figured out how to communicate the awareness of that. A lot of sometimes these companies that get the VC, nobody ever really hears of them because they've not done anything to grow their brand in the marketplace or to grow the trust factor. Because you have to believe, to be successful at raising crowdfunding, you have to build a trust with an investor, just like a regular stock market would, that you are doing things right, legitimately. You've got the data that shows what your business model is. You've been vetted and validated in the marketplace, and you've got a trust factor that you do with your investor that surpasses, because you're not going to sit across the table and be able to convince that investor to invest in you like you can in a traditional angel investor and VC model. You have to earn the trust of those investors that are never going to see you. They're never going to, other than maybe in a video or something like that, they're never going to actually reach out and touch you. It's much more like a stock market. So you've got to have the homework that you've done to be successful in that. And I think it builds, it has the propensity to build a stronger, more sustainable company, because their reach is much more broader when they raise that capital. So when they go public, they have a lot more investors that are there, not just because of a hype, but because they earned the worth of those investors investing in them as customers, and then became investors, that then those other ones that just become investors see that metrics of customers and investors that get there, and that that traditional investor that might have invested in the stock market based off of industry analysis and stuff like that can feel more comfortable investing in a crowdfunded company that has all the metrics of a public company, but they're just not public yet. And so you've got that uptight potential. So I think that it's, when we look back in the 5 years that you were talking about, and we're doing 5 billion in all the different levels of crowdfunding, that it's going to be much stronger companies in the marketplace as a result of having raised money that way. And if they should become a public company at that time, they're much more sustainable to the benefit of the public stockholders that will grow. They're not going to have this feast and famine because there's a lot less hype in a crowdfunded company. Do you agree?
I think, look, I'll give you two examples. Look at WhatsApp. WhatsApp was bought at $19 billion with zero revenue, right? Because Facebook saw that as a bigger threat to their revenue model.
Yeah, they needed it for competitive, to get to competitive, because they were getting their lunch was getting eaten on other things.
Their messenger was, yeah, absolutely. Second is a company that we're currently dealing with, is Clubhouse, which is a competitor of Twitter, which is audio Twitter. So they might get bought by billions of dollars. And I think, coming from your point of view, yeah, these companies haven't defined. It's all about they're using data to build this model. Coming back to crowdfunding, these investors, these customers turned investors are biggest their brand ambassadors. For example, look at a company that might have 10,000 clients, but let's say 3,000 investors have 3,000 of those customers turned entrepreneurs invested $10 in that company, right? At a simple case, it could be 500, but let's just use $10 as an example. What happens? These are 3,000 of your brand ambassadors,
Yeah.
right? Who's going to talk about all of these clients? As these companies scale, not only they're making money, their valuation is growing. Guess what happens? Have you ever? I don't know if earlier when from your background, if you met stockbrokers or bankers or angel investors, when they talk about, hey, I made this great bet in this company,
Yeah.
I invested through crowdfunding $10. He's able to talk about this in larger crowds and pound in his chest. What a great investment, right? So I think with these type of concepts from crowdfunding going forward, they'll have a lot more brand ambassadors,
Yeah.
and which will only build brand equity
Yeah.
and sustainable business models.
Yeah.
Those are my thoughts, and I only think is coming back to traditional venture capital models. Not every company is going to be backed by venture capital, private equity, or family offices. Everybody, I think, crowdfunding is one of those things where you're open to if you think and if you can raise money at a higher valuation compared to what the angel investors or the VCs or the private equity will value at the end of the day.
Yeah.
So this
Yeah.
it's a win-win situation for people who never had access to that company, and two, for those entrepreneurs who weren't valued the right way.
Right. Right. Well, it made me think of when you talk about brand ambassadors. One of the early successes of Reggae Plus in the United States was BrewDog. You probably have heard of them. So, BrewDog was a British beer brewery that had raised their money in England through crowdfunding, like a Reg CF type of well, it wasn't Reg CF. They don't have that. They have different types of crowdfunding. But anyway, they had raised their money to launch their brewery, to do all this stuff, all and never really spend any money in marketing other than promoting their offering. But because of Instagram, anybody that had a beer would be like, I'm here at the brew house, and they posted, and it was like all this. So they had all these people that had little amount of shares, got free beer, I guess, as part of that value proposition, but always sharing it. So when it first came out in the United States for Reggae Plus, they wanted to come to the United States and see and test the waters to see if it would work as well here. So I think they set their offices up, or their location up, outside of Plank Road, and where a lot of the breweries are and stuff like that. And they did a national model, and they originally had a plan to set up like the little micro locations all over the country. And they didn't raise quite as much as what they had intended in the time frame, but they raised $35 million, and they were able to launch this and launch their brewery successfully without debt, and send a case a month to their thing, same, very much similar to England. And then they went out and did a second raise to set up like 5 locations in Texas and California and stuff like that. And so they have successfully used that as a model to gain this. And they don't have a big advertising budget because they have so many brand ambassadors that are constantly social media sharing that they're a shareholder, and that they have this stock and all that kind of stuff. And it's just, it's one of those things that I think when that company decides to go public, they're going to have a huge opportunity to do that, because there's just so many people that are aware of it and waiting for the next time that they raise capital so they can get in and get their small piece of it like that. So I know we're about rounding our time frame that we have here, and I want to bring up, kind of shift the conversation just a little bit, if that's all right, because one of the things that I really love about KiwiTech and the model that you've done, and it has become something, and I don't know if it's just a Southeast issue or East Coast issue, but so many angel groups want companies to have a working product and with some number of customers before they'll even entertain them to raise them, to invest in them. It's really the gauntlet to get through that initial criteria is actually really struggling for companies that maybe they got a basic MVP, but it's not a full scalable model. Maybe they did some customer discovery, but they don't actually have customers and revenues. But KiwiTech embraces these entrepreneurs before that when they're really trying to get the product to market to get those customers, and says, we're going to share that risk and help you with that. Why do you think KiwiTech is so much more successful, even though it's risky that way, to embrace those earlier stage companies that are really truly at a seed stage versus a lot of these angel investor models that want to, put the burden of all of that on this entrepreneur that has very limited resources, before that they'll entertain even looking at a deal?
So our experience is, look, we are not looking at 16, 17, 18 on perhaps Mark Zuckerberg's of the world, right? What we invest in is in teams, people, strategy, background. Mark Zuckerberg, what he has done, but you also understand how many students are in college. We only talk about success rate, but we don't talk failures, right? So that's, you have to understand and see where you're going. We invest in people. We invest in people who wants to grow and have it, who knows how to pivot. 90% of an entrepreneur's life investing, they're not going to get the first client they go after. They're not going to execute in the first strategies. You have to, we get like, there's a company in our portfolio called Hungry, which is disrupting a $21 billion corporate catering place. We invested in that company, or we got involved in that company at $8.5 million valuation. This company raised Series A before the pandemic. Their revenue hit zero, then it excelled, right? They're in the market to raise Series B. They're doing so much better. And he's a four-time, I believe he's a four-time entrepreneur, Jeff Grass. That's something that excites us, right? That
Sure.
they have figured this out. They know what to do. And those are the entrepreneurs who work with us, teams who have worked with us at workplaces, and they're able to sell us on those type of vision, right? Meaning this is what they're trying to build. That's why KiwiTech is able to embrace that risk. Sometimes an executive spends 10, 15, 20 years in the workplace. Then he wants to build a company. Sometimes they want to spend 5, 6, 7 years before they want to launch something. Our job, if we believe in that idea, right, is obviously we do our own due diligence, which is like an angel type due diligence, and we see where this company might go. And we want to empower entrepreneurs. We don't want to be a roadblock in these entrepreneurs. We want to give them wings so they can fly, right? So that's, I talk about empowerment over and over. I think a lot of over 20 or 25% of our portfolio is out of women. More than 25% are women and minority-based founders. So we are making a difference in this marketplace already.
Yes.
And I think the best is yet to come, because now, we know a lot of these angel investors across the country. That's how we came across you. They're sharing their deal flow with us and helping us. Hey, why don't you work with this company? This is a great idea for you. What do you think about this? Now they're involved with our ecosystem. And I hope, the blessings keep on coming and KiwiTech keeps on growing, because this is definitely an exciting time for KiwiTech.
Yes, absolutely. And so for those folks listening, kiwitech.com, right? It's just a straight up name, Kiwitech.com is how you go find all about that. And you look there, you can see the events. They've got how to apply. They've got all kinds of, it's great. And I think all of the prior webinars and things are available on the website as well, right?
Absolutely. We do about 100 events a year. You can look at all of these things. Why do we do angel panels? Because this is where angels from Harvard to beyond to Baylor, the top tiers, they come and tell them what they're investing in, who their top, it's a direct context. You come to us, we'll put you in touch with a lot of these angel groups. Our job, we are not a banking firm. We not take cut of any investment money you raise from our platform. Our only job is to create the largest startup ecosystem to empower you so you can build a great company.
Yes. Okay. I thank you so much for taking time, getting to a place in India that you could participate in this. I really appreciate it. I'm looking forward to to meeting you and your journeys through back into America and meeting you face to face, breaking some bread together. And any final comments you'd like to share before we wrap?
If you have a dream, build it. Don't hold back. This is probably the best time in history to become an entrepreneur. And if capital is stopping you from building a company, that means you're not trying hard enough. Please, if you have an idea, think about it, meet people. This world is worth making a better place, but it also needs your contribution. So please don't stay back, don't stay on the sidelines. Come and participate and help us build a better planet together. Thank you.
With that, onwards and upwards. Thank you so much, Harjit.
Thank you, Karen. Have a good one.